Well, Karen, what we've seen is a very resilient global economy in the second half of last year, and that's going to carry over into 2024. We've seen the U.S., United States has been doing better than expected. Their economy has been very resilient. China, of course, China is slowing down on account of the property sector problems they're having, but they also have been revised up. They've been doing better than we projected in October. And then a number of large emerging market economies, Brazil, India, Southeast Asian economies, Russia, have been doing better as well. And this is a combination of strong demand in some of these countries, private consumption, government spending, but also, and this is quite important in the current context, a supply component as well. So very strong labor markets, supply chain frictions that have been easing, and the decline in energy and commodity prices.
Pierre-Olivier, what's coming through in the report, though, is a growth adjustment because of higher for longer interest rates. Yet central banks are still concerned as to whether they have slayed the inflation dragon. As you look ahead and assess the disinflationary trends, is the scene set for the Fed to cut interest rates soon?
Well, that's the other piece of good news in our report is inflation has been coming down faster than we anticipated. And so we're now projecting, global inflation is going to be around 5.8% in 2024. We're expecting 4.4% in 2025. That's global. If you look at advanced economies, for instance, we're expecting inflation to be at 2.6% this year and then 2% in 2025. So in a nutshell, the battle against inflation is being won, and we have a higher likelihood of a soft landing. So that sets the stage for central banks, the Federal Reserve, the European Central Bank, the Bank of England, and others to start easing their policy rates once we know for sure that we are on that path, that we are going to be hitting the targets later in the year and into 2025. So I think the projection right now is that central banks are going to be waiting to get a little bit more data. They are going meeting by meetings. They are data dependent, confirming that we're on that path. That's the baseline. And then if we are, then by the second half of the year, we'll see rate cuts.
And Pierre-Olivier, there's a real debate going on in markets, though, as to whether central banks like the Fed should get going sooner rather than later when it comes to the rate cuts. When you look at the growth profile here, we certainly avoided any form of a landing over in the United States last year. This year, what are the chances of a hard landing versus a soft landing and no landing at all?
Well, this is a very interesting juncture for central banks right now because precisely we're coming in, within sight of the objective. So we have to be careful, and they have to be careful in how they're going to formulate policy. And the risks are really two-sided. And that's a big difference compared to where we were maybe a year ago, where really at that point there were a lot of downside risk on growth and a lot of upside risk on inflation. Now the risks are more broadly balanced. And on monetary policy, what it means is that one has to be careful not to ease too early, because that would basically mean that policy would become too accommodative before we get there, and inflation would persist longer, and that would not be good for the global economy. But there is the other risk, which is coming into sight, which is that policy could remain tight for too long, and then that would slow down growth, and possibly inflation would come below central bank targets, below 2% for advanced economies. And I think there's a careful discussion going on in central banks right now around these two scenarios. Countries like the U.S., we see the demand being still very strong. We see the labor market extremely strong. There might be a concern about easing too early. You look at the euro area. A lot of the inflation there is not really demand-driven. It's really the energy crisis, energy price shocks. So there might be a concern that, the economy might slow down too much if rates remain high for too long.
How watchful are you around the geopolitics as a wild card? Cited in the report, concerns still around commodity prices, whether they take off again, and also whether we see some of the supply chain issues thanks to the Red Sea shipping lanes also undermining progress around inflation.
That's certainly one of the risks that we see around our baseline. I mean, we're already incorporating some of the disruption we've seen since October in terms of the maritime shipping being disrupted in the Red Sea, in the Suez Canal, and we're seeing a lot of shipping being diverted around Africa, for instance. That is increasing costs, that is increasing delays. As of now, we are not seeing this as having a major impact on overall inflation. So yes, there is a supply component to this, but it's relatively moderate, and we're not seeing a huge increase in costs or huge upswing in inflation coming from that. But we have to be vigilant, and things could escalate. There could be disruptions in energy markets. So there are a lot of scenarios where things would become worse in that space.
Turn to the UK and just how soggy a picture we're looking at this year, because the growth improvement on last year seems very slight at this stage. Still stubborn inflation sticking around as well. What's the outlook for the UK in your view?
Well, what we have here is there is relatively weak growth in 2024. We're expecting about 0.6% for 2024. But the news on inflation has been relatively good. That's one of the big news since our last round of projections. We're now expecting UK inflation to be only 2.8% in 2024, and that's come down quite a bit from what we were expecting just 3 or 4 months ago. So there's been a lot of progress in that sense here, and we're seeing growth. We're expecting growth to resume in 2025. At that point, we think that the Bank of England will have been in a position to, bit like the Federal Reserve and the ECB, to ease the policy rates as inflation is finally brought towards target.
Yeah, Olivia, I've got about 20 to 30 seconds, so let me ask you quickly about China. How hard is it to forecast? It seems like we've got perhaps faster cleanup of the property market thanks to initiatives in the courts this week, but also more stimulus coming through. So how hard is it to forecast on China for this year?
Yeah, our forecast has been revised upward. So yes, there is a slowdown. Growth was 5.2% in 2023. It's expected to be only 4.6% in 2024. But that's been revised up in part because there's been some fiscal support coming from the Chinese government to try to support domestic activity, to try to also help the property sector. And that is sort of increasing growth into 2024.